This is the Real Estate Power Play Podcast, getting you the information that you need to be a successful real estate investor. Hosted by Mark Monroe, Ronald Walker, Gabe Rodarte, and me, Marty Grizzanti. Combined, we've done thousands of real estate transactions. So get ready for real stories and true case studies on finding deals, growing portfolios, and making money. Welcome to the show.
Hello, everybody. Welcome to Real Estate Power Play. My name is Mark Monroe, and I'm super excited who we have on today for a guest. And we have Max from Call the Underwriter. Max underwrites a lot of seller financing loans for residential properties, and we're going to dive into today for real estate investors that are doing seller financing notes. You know, if they're doing a subject to wrapping it, seller financing, any of those things, we're going to dive into that. And Max is going to kind of go over his process. I know he's getting really busy because the market has shifted quite a bit. If you're listening to us or following us on YouTube, on any of your favorite podcast networks, or follow us on YouTube. But Max, welcome so much. Thanks for coming on. I really appreciate it. How you doing?
Good. Thank you. Thank you, Mark. Happy to be on here and excited to talk to your people.
Appreciate it. So, tell us a little bit about yourself and your, how you came into Call the Underwriter, and how, then we'll dive into a little bit about, what you guys are doing, and we'll talk a little bit about the Dodd-Frank Act and everything. So where do you live? I know you're where, because you look cold.
Yeah. We're out of Montana. Yeah. You can probably see the wood stove going in the background there. So yeah, actually I'm sitting up in the woods at a cabin I have in Montana right now.
Nice.
And I'm building a new house on the other end of the property. And so we're sitting at about 4 feet of snow right now. And yeah, it's definitely typical Montana up here right now.
Now, you guys got dumped on a lot this year, more than normal, correct?
We did. Yeah, absolutely. Yeah, I'm still plowing paths with my tractor to get to and from the main county road to get back in here.
So they're saying, you guys going to have snow to almost possibly August this year or something like that?
It wouldn't surprise me a bit. You can't even, like, down along the creek and everything back in here, you can't even walk down there because it's up to your waist. So yeah, this is a manly winter for sure this year.
So have you guys actually been stuck in and, hybrid down until you finally get out a little bit?
No, I've got a tractor, and so I keep it plowed as we go. So we get in and out just fine. But yeah, there's no walking off the main trails yet for sure. So
are you originally from that area?
Yeah. I've been here my whole life. So yep.
Nice. So how did you get into doing the whole, underwriting, for the staying compliance, the Dodd-Frank Act and everything? Why don't you kind of dive in a little bit about that? And why don't you explain to everybody that's listening to us, because there's a lot of like newbies and investors, wholesalers and stuff, they were doing wholesaling when the market was hot. That kind of dried down a little bit, and now they're shifting over doing seller financing as subject twos and doing wholesaling. And a lot of people don't even know about these type of regulations, and that's kind of why I really wanted to do this podcast with you, to kind of inform people. People don't know what they don't know, and hopefully we're going to bring a lot of education to everybody today.
Yeah, amen. Yeah, good stuff. Okay. Yeah, so yeah, my background started in terms of real estate. I was a licensed realtor starting back about 1990, and did that on the side for a number of years. And then that got me started buying rental properties and doing creative finance to build a rental property business. And so I worked on sort of a lot of the same ends that my customers now are on. And then that sort of morphed into understanding the need for underwriting and the Dodd-Frank side of it to service the seller finance community. And now for the last several years, that's been our mainstay, is just helping everybody creating notes to make their notes compliant, and help and try to create a one-stop shop per se, so that a ma and pa note creator can bring their deal to us, and we walk them all the way through the process until they're sitting at the closing table, and this thing is a recorded note. And now we're even helping them resell that note and we're providing full loan originations in all 50 states now. And so I can speak to some of the specifics in terms of what does a new note creator need? And then B, how do we fill that need? And what does that look like on the receiving end? If you're this person going out and combing the boroughs and the neighborhoods for rehab inventory, let's say, another thing that we're doing now is helping our investors get gap funding and lines of credit and everything necessary for them to continue to procure more inventory. And so while they're out creating new inventory to do their next deal, then we try to be very instrumental in taking their current deal from maybe the contractual point, right? We help them pre-screen their borrower, and then we take this file. Now they can go back and start working their next deal and working on next month's inventory issues while we finish this deal for them all the way to the closing table. And that's sort of what we're doing now.
Right. Well, why don't you talk a little bit, first of all, what Dodd-Frank is and why it's required. And, it's, as we know, it's mainly for people that's going to be living in a property as a primary residence. There's a lot of consumer protection regulations to help to protect that consumer versus if you're selling it to an investor, then these rules are exempt. So, kind of give everybody a quick overview of what Dodd-Frank is and why it's required in today's world.
Sure. Okay. I'll do that. Before I go that direction, so when we talk about that, we're going to be talking about what is Dodd-Frank, required, and that's going to be any owner-occupied property of 1 to 4 families. So even if you're doing a fourplex and the person buying it plans to house hack and live in 1 unit, if that's going to be their primary residence, then that still is under Dodd-Frank. But for everybody listening out there, there's a lot of other reasons why we underwrite and do loan origination besides just Dodd-Frank. So we do a ton of underwriting for investor to investor properties as well. And the reasons for that are twofold. Number one, you as the investor, you still need somebody to help you vet the credit worthiness and the risk of this prospective borrower. And the other issue is if you're interested in selling this note after we help you create it, then you're going to want to create a professional underwriting collateral file that you show to prospective note buyers that's going to help you get top dollar for this note after we help you create it. So underwriting really is both for Dodd-Frank purposes and for investor value purposes, and we underwrite a lot of both. Now, changing gears and going back to the Dodd-Frank issue, for anybody that doesn't understand Dodd-Frank well, it's probably easiest just to give a really brief, quick history lesson, and that expresses the intent.
Got it. Before you do that, I want to pull Marty on. Marty's been trying to get in here. He had some technical issues, and I want you to introduce you to Marty. Marty, meet Max. Max is from Call the Underwriter. Welcome to us today, Marty. How are you doing up in Marty's from upstate New York, and Max is out of Montana. So you guys are in the cold part while I'm down here.
Yeah, that's right. That's right. Max, welcome to the show, my friend. Glad to have you on here.
Thank you, sir. Good to meet you.
Good to meet you. No, keep going. This is really, really good stuff. I was in the lobby, as it were, of our podcast. So I'm excited to hear about more of this because this is really needed right now, right? This is where, hey, creative deals are all over the place, and especially when times are tough and it's tough to make deals, work. Traditionally, well, let's figure out how to make them work. Right? Good deals, sometimes you have to make good deals happen. So this is really good, Max. So I'm just going to shut up and keep listening to you. So you keep doing your thing, brother.
Okay. So anyway, for everybody listening that would say, why is Dodd-Frank a thing? Why does my business model need to consider and comply with Dodd-Frank? Easiest way to understand it is to follow the mortgage sector history. going back to about 2007, 8, in the infamous housing bubble burst, right? And so prior to the housing bubble burst, we had sort of a Wild West frontier mentality with respect to lending. And this isn't a slight on seller finance. This is the conventional sector actually that caused this. But in general, right, we had a lot of rogue business practices. We had teaser rate loans. We had adjustable rate mortgages. We had failure to properly disclose the future tendencies of mortgage notes and amortization. We had neg-am loans. We had stated income loans. We had a million what they now call irresponsible, risky features plumbed into lending on the conventional sector that all played a massive part in essentially what created the housing bubble burst. And so we were allowing people to walk in and tell a mortgage broker that they made $10,000 a month on a stated income loan. They never had to show a single document, and the bank would play a shell game with them and say, well, we could put you on this introductory rate for this $600,000 house, and guess what? Your mortgage won't be any more than what you're currently paying now for rent. But failure to disclose to them that in 24 months that teaser rate will expire, and they'll be at a 6% interest rate on a $600,000 house, and they'll have a $6,000 a month payment. And so all these things cascaded, and all of a sudden we had people, when the economy got shaky and people were losing their jobs, all of a sudden we had a series, essentially an epidemic of people that could no longer afford their mortgage rate, and consequently they went into forbearance, then foreclosure, and then even bankruptcy, right? And so we had massive amounts of people walking away from their mortgages, and then that resulted in the government having to bail everybody out. So at the end of all of that, around 2010, Congress was charged with dissecting the housing bubble burst and doing an autopsy on that, and determining what the causative factors were, and then more importantly, creating a new roadmap going forward, right? How will we regulate to shore this up and fix these problems and ensure that future housing bubble bursts don't happen? So that is the history of Dodd-Frank. So Dodd-Frank was born in 2010 under Senators Barney Frank and Chris Dodd, and they sponsored this legislation that created the Dodd-Frank Act, and they decided in general that the onus should be on the lender and no longer on the borrower on what you could afford. So things like stated income loans went away, teaser rates went away, negative amortization loans went away. And so in the sector, with respect to primary occupancy, the attitude and what needs to be understood is that what Dodd-Frank is regulating is they're regulating all of your practices as a lender if it involves somebody's primary residence, and their default or failure in this transaction could result in another family being homeless in America, then that is under Dodd-Frank. And so what happens now is when you go out and create a business model where you're going to buy foreclosures, repos, fixers, flips, REOs, any of those properties, and you're going to fix them up, and then you're going to resell them to somebody that can't get a bank loan, then the law speaks to you as the lender and says you have a legal responsibility to ensure that your borrower can meet the repayment requirements of this loan. And there's 8 general metrics that you have to measure your borrower by. They call them elements of ability to repay, ATR for short. And so what our company does is we jump into partnership with you, and we say, listen, we're going to help you stay legal and continue doing what you do best, which is going out and drumming up deals, right? You want to be busy in your area, churning 10 or 15 deals a month. And so our part in your partnership is going to be when you create this inventory, and we teach you how to pre-screen your borrower so that they're most likely to meet these elements. You go onto our website, you pre-screen your borrower, you send us a term sheet, you have your borrowers apply online on our application, and you bring this deal to us. Now you can go back out and get back busy trying to find next month's deal. And we're going to work this deal all the way to the closing table to help you put a legal qualified borrower in this new property and create the strongest, most attractive note that you can create. And that allows you to continue doing what you're doing and create a safe, professional, non-predatory, repeatable business model from deal to deal.
Love it. I love it. I was actually curious, Max, because there's still, I was talking to, when you were talking about the foreclosures and that occurred, I was talking to my short sale specialist, right? She's an agent, and that's a whole different beast, right? Handling short sales.
Yeah.
But she had said to me, I wanted your opinion on this. She had said that we haven't even seen the full wave from the 2008 crisis of potential pre-foreclosure, foreclosure properties. What kind of wave do you think we're going to have here coming up? And do you think that there's still stuff from the previous financial crisis?
Oh, sure. Oh, yeah. Yeah, absolutely. The other thing about it is that despite all the responsibilities put on lenders to ensure that borrowers have the ability to repay, nobody has a crystal ball, right? So nobody can still predict the instability of society, the instability of the workforce, and the instability of rising inflation and family dynamics, right? Our society is in decay. And so the foreclosures are going to continue into perpetuity for a lot of other factors than just the fact that we have rogue, irresponsible lenders. So a good example would be, Dodd-Frank charges a lender with ensuring that your underwriting standards can be proven to result in historically low default rates. In other words, it's not your terms and policies and your deals that are contributing to the foreclosure, and you have to be able to prove that. But that's not to say that foreclosures won't be continuous into the future. And a good example would be, you get a family, let's say, with a 620 credit score and 2-year work history and decent income, and we get them qualified for you. And we've got the terms of your deal, and they're all compliant. None of the risky features that are prohibited are in your deal. Your borrower meets the 8 elements of ability to repay. But now, 6 months after we put this person in this deal, the Amazon gig job that they have lays off 10,000 employees, and they find themselves out of work. And the current inflationary trend spikes up even higher, and these people now can't pay the deal, and you're still forced to foreclose on them due to no fault of your own. That's never going to end. And I think anybody that believes that just increasing the responsibility for higher quality lending practices on the seller finance lender is going to put us in a utopia and end all these traumatic foreclosures is wearing rose-colored glasses. It's not going to happen. And so we have to address all this with a cognizance of reality. Foreclosures are still going to happen. So we want to make sure that you're well collateralized, that we create a note that's safe and legal. If it's challenged, that they don't want to put you behind bars as a predatory lender, that we build you a collateral retention file that demonstrates the professional, compliant nature of your business model. But understand that disasters are still going to occur. And so we just position you to weather that storm when they do.
Yeah. And Max, I want to piggyback off what you're saying there about, being seen as a predatory lender situation. So, investors that are listening to us right now, and if you're just doing assignments, like if you're structuring a seller financing deal and you're just letting, and you're thinking, because you're just, what I see out there happening, these guys are just looking for an assignment fee. They're trying to get the largest assignment fee as possible. And they're not even making sure that the buyer and the property can qualify. If you put somebody in that property and you're the one that's structuring it, and you're structuring this deal with a seller, and your intentions is just to do an assignment, you are going to get pulled. If they default and stop making payments, you're going to get pulled into this because you didn't set up this right way. So it's been, I've talked to a couple of different attorneys, and it's really hasn't anything happened in the last few years because everybody's been working on the hot markets with the wholesale assignment fees. But you technically could be seen as a originator because you're the one that's structuring this deal. And even though if you're doing an assignment, and then technically you could also be seen that an assignment fee, if you're being an originator, that assignment fee could also technically be considered, has to be included in the APR, and it could be usury law. So you just want to make sure that you're guiding the seller, if you're doing an assignment fee, that you're doing things the right way, because you could get pulled into this, and people don't realize this. And that's why we're doing this, to educating people on that.
Yeah, absolutely. And that's a great point. And the actual NMLS definition of an originator is anyone who solicits or helps negotiate the terms of a home mortgage, and anybody who takes application from a borrower. So absolutely. If you're diving into the middle of that and you're advertising and you're bringing borrowers to the table and you're helping orchestrate this deal, the law will absolutely view you as an originator. Therefore, all those responsibilities are absolutely on top of you. Yet you don't have an NMLS license. And so now you can be guilty of unlicensed activity on top of that. So, and I don't say any of this to scare people. That's not my job. My job is to try to work on behalf of seller financiers to help you navigate this incredibly convoluted, strictly regulated industry, and help brand your business and stand you up to defend yourself and produce consistent, reliable underwriting retention files that demonstrate transparently your regard for Dodd-Frank and your regard for borrower safety. That's what we're really all about. And so when you guys come to us with your deals, what we're doing is we're helping do that heavy lifting of understanding the compliance and helping you create a track record that when, let's say, 1 in 10 of your deals finally goes into foreclosure and somebody comes snooping, you can gladly open your file cabinet and say, hey, have a look at everything we've produced, because you're going to notice everything we've produced is compliant, it's consistent, it's well disclosed, and we have transparent business practices that are repeatable from cycle to cycle. And so, those are the investors that are going to weather those storms.
Yeah. And I wasn't scaring, and I wasn't trying to scare people either. I just want to inform people, because a lot of people don't realize and understand this. So that's the only purpose why I kind of came across that. So I just, as I said, I just want to piggyback off what you were saying on that.
You bet. Well, if you will let me indulge me for a minute, what I'd like to do next is talk a little bit about what this looks like, right? So you're an investor and you're sitting at home and you're saying, okay, I get all of that and it's all enormous and it's scary and it sounds like I need help. What does getting help look like? So, excuse me, I will real briefly, as briefly as anything in this industry ever is, attempt to paint a quick picture of what contracting our services will look for you. What's the tangible benefit, and how does it help you do what you do best and continue to scale and produce more. So I don't know where you guys are at exactly, and I don't know where all of your investing crowd is. So I'm just going to pick a city out that we do a lot of work in, and understand that we do cities in all 50 states. So I'm just picking one out of the hat just for scenario sake. But let's say you're in Atlanta, Georgia, and your business model is you're going out and you're chasing rehabs and fixes and flips with the intent of slapping a coat of paint on them, making them better than they were, and then finding a family that can't get a traditional bank loan, and you're going to put them in this house and you're going to carry a note, and then you're going to rinse and repeat and move on and do it again. And you're saying, okay, how can call the underwriter help me? So when you get this property, first off, we can help you in the event that you're looking for repeatable gap funding and you're looking for lines of credit to continue to be able to go out and get more and more of these. Because what happens to a lot of investors is they get a property done and now they're trying to figure out, how do I do my next deal because all my funds are tied up. So we can help you create a sustainable funding program so that while all your funds are tied up in this project, we can free up funds for you to go do another project while we're helping you finish this one. The part of that also is in if you want to recapitalize, we're doing 2-note deals more often all the time now, right? So you're going to come to us with a property and say, we need to get a certain amount back automatically on this so that we can free up to move on to the next deal. How do we structure this note? We'll work with you to help structure the note, typically in 2 pieces, a first lien and a second lien. You might sit back and sit on the second lien yourself. We might help you create a marketable, low discount first lien so that you can recapitalize quick. We'll help you pre-screen your borrower so that the idea would be we'll help you build a note with the sale of the note in mind already, right? So you're not surprised when they're trying to Jew you down and discount you heavily because your note is going to take a beating because it wasn't a well done note. So we help you build a note that will help you sell that note for a premium or as close to premium as possible. And then the other thing that we do, obviously, is we help you when you bring this pre-screened borrower to us. We help you take this thing all the way to the closing table because that's a giant, scary deal with a lot of moving parts in it. So you go to our website. Let's say you've got your house. You picked a rehab house in Atlanta. You advertised. You found a family that's interested in this house, and you think the numbers are right. So what we'll do is we'll help train you to go to our website, get our pre-screening guide, pre-screen your borrower. Once your borrower passes that pre-screening, you have a high likelihood that this borrower is going to work. They're going to fit this deal. So you pre-screen your borrower, you send your borrower to our website to fill out the application. They fill out an automatic application and send us income docs. So we've got one half of the transaction. We've got application coming in with your borrower, and we've got income docs from your borrower. Now you go to the website and you fill out the term sheet, and the term sheet is the other half of the deal. That's your side. And that's telling us that you've pre-screened the borrower, that you've signed a contract, that you've taken earnest money, and now you share the terms of what this deal is going to look like. And so these two both come to us and they hit our pipeline and they now marry together. So now we've got terms from you and we've got the borrower, and here's a complete deal. Now we take that from you and we take over. We start working all the compliance issues. We start drafting loan documents and closing documents for you, drafting your note and mortgage, balancing your settlement statement, vetting your borrower to ensure that they're going to meet DTI, residual income, 2-year work history, 2-year income history, Dodd-Frank credit worthiness standards, all the things that the law says that you have to make sure of. We're doing all that for you behind the scenes. You've handed that off to us. You're now back chasing your next deal. We're running this one all the way through the wickets for you, right to the closing table, help create the note for you. We'll help sell that note for you if you indicate that on the term sheet. So the term sheet is going to ask you several questions that we use to help drive your business sustainably, right? So on our term sheet, you're going to see questions like, do you want help selling this note when you're done? If you answer yes, then we work differently for you than if you answer no. If you answer no, that tells me you want to create and hold this note. And that's okay as well. But then the way we help you is a little bit different than if you tell me you want to sell the note, because the difference between creating a note you want to hold long-term and creating a note that you need to recapitalize on drives me to ask you more questions, right? Help you create a note that's going to sell fast, sell for low discount, and move you into where you want to go next. Another question I'm going to ask.
Hey Max, let me stop you for a second. What's the note selling process look like, right? Where do people buy notes? Like where would one go to sell a note? What does that look like?
Yep.
It's just for people that, regular real estate guys, right? Regular landlords. It's that's a completely different animal in itself.
Yep.
So can you explain that a little bit?
I can. And on my website, I have a note seller's guide that I created. And so one of the services I offer is I help anybody interested in creating notes to sell. I help them understand what makes a good note. I help them understand why notes are discounted and how you can avoid substantial discounts. Probably way too deep to articulate right now, but that's a whole nother phase is helping people that tell me part of my business model is wanting to resell these notes after I create them. Number one, you don't want to wait until you've created the note to decide you want to resell it. It's way late in the game. That would be kind of like buying a car and then getting really interested in finding out if this car has the JD Power crash, survival statistics that you and your family want, right? That'd be kind of silly. Go buy your Ford Explorer and get it home and sign a contract and then say, now I want to make sure that I'm buying the safest car statistically in this class now that I've bought this Ford Escort and got it home, or Ford Explorer and got it home, only to open up and start studying everything and then go, oh man, I wish I'd have read this before I bought this Ford Explorer. A little bit late. So same thing. We don't want to create notes and then say, what can I get if I want to sell this note? We want to front load that and reverse it and say, we're at the foundational stage of building this structure. Now we want to know what selling this would look like so that we design and architecturally engineer this thing from the foundation up to the top, because when we've got this thing built, we already built it knowing what the sale needed to look like. That's what we help these guys do. Otherwise, you just take a beating, right? Now you find out, well, your borrower has a 250 credit score. They've got zero credit worthiness. They barely passed the Dodd-Frank bar for ability to repay. You've got, excuse my French, but you've got a garbage heap of a house in a garbage heap of a neighborhood with a garbage heap of a buyer. And now you're wanting premium resale on your note. It's not going to happen. And so sadly, if you're needing to resell this note, you're going to take a beating. And so what we do is instead is we start at the foundational level and we say, we're going to help teach you how to get a good structure in a good neighborhood with a good borrower, and then a great underwriting collateral file. And then the note sale will take care of itself, right? Because we're going to create a quality widget in the widget factory so that the buying end, the selling end of this widget, all those questions are already answered for you because we built the thing with that sale in mind. So hopefully that makes sense.
Yeah,
Thank you.
That makes sense. Yep.
You bet.
Are you actually, speaking of the notes, are you going to the Diversify Mortgage Expo in Nashville, June 1st?
I am not, with great apologies to everybody in the community, including Nate Turner, I believe is the one running that one. Yeah, I already apologized profusely in advance for not getting there. I'm building a brand new house over here, and besides the fact that our business is blowing up before our eyes, I wake up early in the morning and do business, and then when it gets warm enough to get across the way, I put on my tool belt and I build all day. And then I come back in the afternoon and I satisfy more business. And so I'm just too swamped right now in June. I'm just too swamped. I'm not going to make it this year.
That's good. I just booked today. I'm actually speaking at that expo.
Okay.
So,
great.
Yeah, looking forward to it. So good group.
Great.
So we'll miss you there, but I'm sure your name will come up quite a bit, you know?
Yeah, for sure. And tell everybody, you know, I'm happy to give my time away. I just can't get on a plane and fly away right now, but people can call me on the phone. I do this all day long for people, and I do this for no charge. So I coach people and help people all day long. I'm not one of those business models that's trying to get billable hours. So, you know, all the people that I'm helping, and I probably shouldn't say this, my wife, you know, shames me all the time for this because I can end up spending the whole day on the phone and not actually get any work done. But, you know, it's the farmer's model. I'm planting seeds for future harvest. And so I spend an awful lot of time coaching and helping people, but I do it on a one-on-one so much more than I do in terms of speaking, you know, to big groups.
I love it. I love it, Max. And I appreciate you coming on here and giving us your time. And, you know, one of the things that's for someone that's brand new to this whole world of like creative financing and notes and all those things that you were talking about, are there certain, and Mark maybe has mentioned this beginning of the show, but is there certain properties that really fit these criteria? Like, is there certain like sellers? Like if I'm approaching a seller, how would I talk to somebody about, you know, structuring something where I could then go to you? Like, what does that look like, I guess, for somebody that's new? Is there a lead type that's best that you've seen over time to find deals?
You're referring to the early end of the phase of acquiring inventory?
Yes.
Not a lot, other than just to say again that a crappy house makes a crappy note. So don't think that you can pick up meth houses and turn them into brilliant notes. Note buyers aren't stupid. So you've got to answer the why before you begin the process. So I'm creating a note. Why am I creating the note? Do I want to hold the note into perpetuity, or do I want to sell the note? The answer to that why drives how we'll help you move your business model forward. Now, if you're a ma and a pa and you just physically want to create a note or two that you're going to personally hold forever, then, you know, your why is a little bit different than somebody creating business model wanting to churn 20 a month. And so the way I would advise you would probably be a little bit different, right? Some of the things that you need to be worried about, your great aunt Elma just died and left you a house, and all you want to do is one time create a note on this thing at 10% and hold this note. And, you know, Elma and, you know, Edgar are going to sit back in retirement and manage this one note that they have. Well, then they're probably got a little bit more flexibility in terms of what they do than the guy that's trying to go out and comb up 20 deals a month, but he knows his sustainability model says that he's going to have to resell a second on or resell a first on every single one of these that he's producing. Well, then we need to be really methodical and thoughtful about helping him engineer that plan, because if he knows ahead of time that he has to recapitalize by splitting these notes and selling firsts off on every one that we help him do, well, then he needs to be looking for the kind of properties that note buyers want to buy. And he needs to be creating the type of buyers that note buyers want to manage, right? Note buyers, unless, you know, they're just, I guess, you know, ex-daredevils, or don't typically get in the note buying business saying, I want to buy a whole bunch of future non-performing notes. That's not in anybody's business model. And so, you know, if you don't want to sustain massive discounts, you've got to consider all that in creating notes going forward. So I would just say in general, the long-winded answer on that is, you know, if you don't want to live in it, nobody else wants to live in it either. So slow down and try to buy stuff that's going to be attractive for future audiences.
Love
Nice,
it.
nice.
Thank you.
Well, we're coming to an end. That was great stuff, and I really like it. So, Max, how can everybody reach out to you and they can locate you and find you?
Yep, absolutely. www.calltheunderwriter.com. You can contact us on there, and that'll send an email directly to me with your questions. And usually your questions are answered by me with other questions or an invite for a phone call where we can discuss things. Understand that we're your answer from start to finish for pre-screening your borrower, helping you create a sustainable business model for future inventory and capital needs, help you create and sell a strong note, make your note compliant and legal that will stand up to the challenges. We provide full loan origination in all 50 states now. We provide underwrite only in all 50 states. We have a second to none closing doc package that will take your transaction from signing of the purchase agreement and taking the earnest money all the way to sitting down at the closing table, drafting the note and mortgage and the whole bit. So I think we've got this down to a point where we can make it very fluid, streamlined, and, simplify your life so that you can go back to doing what you do. What you do best is acquire inventory and make deals. What we do best is help you turn those deals into quality notes.
Love it.
All right,
well,
perfect.
That's great. Fantastic. Appreciate that, Max. Thanks for coming on the show. A lot of value. I'm going to have to re-listen to this again. Mark, as always, good to see you, brother. My baby's crying upstairs, so I have to go.
Yeah.
But,
Congratulations, by the way. He just had a
thank
baby
you.
a couple of days ago. Congratulations.
Thank
there, Marty.
you. Thank you. First child. Excited. And
Awesome.
I'll make sure he listens to this episode as well. Anyways, guys,
Matt,
that's it.
Yep. Max,
Awesome.
I appreciate it. Thanks so
Yep.
much. Anybody listening to us, please favorite, share this video or the podcast. We really thank you guys so much. And thank you guys so much. Take care of you, everybody. Take care, Marty.
Bye-bye.
and Matt.
Thank you. Glad to help. Bye-bye.
Thanks, guys.
This has been another episode of Real Estate Power Play, guiding real estate entrepreneurs to a brighter future. If you liked what you heard, consider subscribing wherever you listen to your podcast or follow us on YouTube at Real Estate Power Play.